Stop scrolling TikTok, I'm serious. Stop watching that video of some guy explaining why Taylor Swift concerts affect the economy for the 14th time. Close the tab where you're looking at electric vehicles you can't afford. You're not buying a Tesla tomorrow. Exit out of LinkedIn where you're pretending your boss's motivational post about grinding actually inspired you. Nobody believes you. Are we clear? Good. And one more thing. If you own silver, any silver coins, bars, mining stocks, ETFs, do not look at your brokerage account until after you finish this video, because what I'm about to tell you is either going to make you panic sell at the worst possible moment or FOMO buy at prices 40% higher than today. And I need you to do neither until you understand why the Pentagon just classified silver as a national security threat. December 9th, 2025. The Silver Institute, in partnership with Oxford Economics, released a 47-page forecast titled Silver, the Next Generation Metal. And buried on page 12 is a projection that violates every principle of supply-demand equilibrium. 59%. According to Oxford Economics data published December 9th, 2025, electric vehicles will account for 59% of automotive silver demand by 2031. Not 30%, not 40%, 59% 6 years from now. And here's what makes that number impossible. Automotive silver demand is already growing at a compound annual growth rate of 3.4% between 2025 and 2031, according to the same Silver Institute report. That's before you account for the EV explosion, before you factor in charging infrastructure, before autonomous driving sensors multiply silver loading per vehicle. 59% of a market that's growing 3.4% annually. That's not a forecast. That's a supply crisis with a countdown timer. But 3 weeks after that report dropped, something even bigger happened. November 7th, 2025. The U.S. Geological Survey, acting on behalf of the Department of the Interior, finalized the 2025 list of critical minerals. And for the first time in the program's history, which began in 2017, silver made the list, not as a precious metal, as a critical mineral. The USGS defines a critical mineral as, according to their Federal Register publication dated November 7, 2025, commodities which are essential to the economic or national security of the U.S. have a supply chain that is vulnerable to disruption and serve an essential function in the manufacturing of a product, the absence of which would have significant consequences. The Pentagon doesn't add materials to that list because they're thinking about jewelry. They do it because national security depends on supply security, and they just told you silver supply is not secure, while the metal is trading at $31 per ounce. While sitting on a cumulative 5-year structural deficit that, according to the Silver Institute's November 2025 data, totals approximately 820 million ounces from 2021 through 2025. That's 10 months of global mine production. Gone. Consumed. Not coming back. Let me put 59% in perspective because I need you to understand the magnitude. Today, in 2025, electric vehicles account for approximately 30% of automotive silver demand according to Oxford Economics, with internal combustion engines still consuming 55% and hybrids taking 15%. That means in 6 years, EV silver consumption nearly doubles its market share while total automotive demand grows by 22%. Think about what that means. The automotive sector consumed approximately 74 million ounces of silver in 2024, according to Silver Institute data. If that grows at 3.4% compounded for 6 years, you're looking at 94 million ounces by 2031, as Oxford Economics forecasts. And 59% of that? 55 million ounces, just for electric vehicles. That's more silver than the entire U.S. automotive sector consumed a decade ago, in one vehicle category. And here's the trap. Automotive is only 7% of total silver demand. Solar is 20%. Electronics another 15%. AI data centers are exploding. Medical applications are growing. Jewelry, coins, industrial applications. The list compounds. EVs aren't replacing demand. They're layering on top of it. While mine supply, according to the Silver Institute's 2025 market data, sits frozen at approximately 813 million ounces per year. The math doesn't work. It cannot work. And the U.S. government just confirmed they know it by putting silver on the same list as lithium, cobalt, and rare earth elements. Why is this happening? 3 forces are colliding. Force 1. Government-mandated electrification. California requires 100% EV sales by 2035. The European Union bans combustion engines by 2035. China's EV penetration hit 37% in 2024, and Beijing wants 60% by 2030, according to IEA data. These aren't goals. These are laws with compliance penalties that bankrupt automakers. And every single one of those electric vehicles needs silver for battery management systems, for power inverters, for electrical contacts, for charging infrastructure. According to Mexico Business News reporting on the Silver Institute data in December 2025, EVs require approximately 25 to 50 grams of silver per unit, significantly more than the 15 to 28 grams in internal combustion engines, 25 to 50 grams. Multiply that by the IEA's forecast of 45 million EVs sold annually by 2030. Let's use the conservative number, 30 grams per vehicle. That's 1,350 metric tons, 43 million ounces, just for new vehicles sold in 1 year, not including the charging stations that need silver-plated contacts for fast charging capability, not including grid upgrades, not including the solar panels needed to power those chargers because governments mandate green charging. 43 million ounces that weren't in the demand equation 5 years ago. And that's the conservative estimate using the low end of silver loading. Force 2, the AI infrastructure boom. According to the Silver Institute's December 2025 report, researched by Oxford Economics, total global IT power capacity increased by approximately 53 times, from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. And that's before the AI explosion really hits. Why does AI require silver? Because data centers running ChatGPT, Claude, Gemini, every large language model, every training run, every inference query requires massive electrical infrastructure, and silver is the most conductive metal on Earth. Every server rack in an AI data center, every cooling system, electrical contact, every backup power supply, every high-speed interconnect between processor and memory, silver. Microsoft announced plans for AI data center expansion costing over $100 billion through 2028. Google is building capacity increases of 40%. Amazon Web Services is expanding. Meta is building. Every single one of those facilities is a silver sink that cannot compromise on conductivity. 1 millisecond of latency in AI training costs millions in compute time and electricity. They're not using copper. They're not using aluminum. They're using silver-plated contacts and silver-based thermal management because nothing else performs at the required level. Force 3, solar's non-negotiable demand. The Silver Institute forecasts that solar photovoltaic installations will continue growing despite technological improvements that have reduced silver loading per panel by 15 to 20% in recent years through thrifting efforts. But here's where it compounds. EVs need solar to be carbon neutral. Data centers need solar to offset their electricity consumption because shareholders demand ESG compliance. Governments mandate solar as part of net zero commitments with legal deadlines, and solar panels cannot function without silver paste for photovoltaic cell conductivity. According to research from the University of New South Wales cited in Money Metal's December 15, 2025 analysis, solar manufacturers will likely require over 20% of current annual silver supply by 2027. By 2050, solar panel production will consume approximately 85 to 98% of current global silver reserves, not supply, reserves. The metal in the ground that hasn't been mined yet. Together, these three forces create a demand profile that supply cannot meet. Cannot. Not in 3 years, not in 5 years, not in 10 years, without discovering and developing massive new deposits that currently don't exist in permitting or development pipelines. Meet Hans Müller. He runs a Tier 2 automotive supplier outside Stuttgart, Germany, produces electrical connectors and power distribution units for Volkswagen, BMW, Mercedes. According to industry sources, suppliers like Hans need approximately 12 metric tons of silver annually to fulfill their contracts with German automakers. December 2025, his primary supplier, a Swiss refinery that's been reliable for 15 years, sent him a notification. Delivery timelines extended from 6 weeks to 14 weeks. Price increase 18% since September. But here's the real problem. His supply contracts with Volkswagen and BMW are fixed price agreements for 2026 production. He eats the increase. He absorbs the delay risk. He guarantees delivery or pays penalties. And those automakers, they're ramping EV production because EU regulations leave absolutely zero choice. They hit EV quotas or they pay fines that make the silver cost increase look trivial. Hans is stuck between a supplier charging more for longer delivery and clients demanding more volume at locked prices. He called his account manager at the refinery. "Can you guarantee allocation?" The answer, "We're prioritizing multi-year contracts. Spot buyers and annual contracts are subject to availability." Hans doesn't have a multi-year contract. He's been buying year to year to maintain cost flexibility. That flexibility just became a death sentence, and Hans is not alone. According to Investing News Network coverage from December 2025, silver's critical role in economically important industries led the U.S. government to include silver on its list of critical minerals this year. Critical minerals. That's the designation used for lithium when battery plants couldn't secure supply and prices went from $6,000 per ton to $80,000 per ton in 2 years. For rare earths when China threatened export controls and prices exploded 900%. For cobalt when Congo production faltered and automakers fought over allocation. The U.S. government just put silver in the same category, and that designation comes with policies, strategic stockpiling, supply chain security mandates, Defense Production Act authority, potential export restrictions from allied nations to secure domestic production. When the Pentagon labels something critical, they're not hoping market forces fix it. They're preparing for supply failure. They're preparing for the moment when national security applications can't get the metal they need because industrial buyers consumed everything available. Stop right here. If you're realizing this goes beyond a commodity price move, hit subscribe immediately. Smash that like button like it's the last charging port before your EV battery dies. Drop a comment with your country and whether you own any silver exposure right now, any form, because I need to track how global this shortage becomes. Because what I'm about to show you next is the timeline that changes everything. Now here's where the countdown accelerates. Oxford Economics forecasts, published in the Silver Institute's December 9, 2025 report, that EVs will overtake internal combustion engines as the primary source of automotive silver demand by 2027. Not 2031 when they hit 59%, 2027, 18 months from now, the crossover point, the moment when more silver flows into electric vehicles than traditional cars for the first time in automotive history. And that crossover creates a procurement panic that nobody's pricing in. Why? Because automotive supply chains order components 18 to 24 months in advance. If 2027 is the crossover, procurement managers at Tesla, BYD, Volkswagen, GM, Ford, Toyota, Hyundai, Rivian, Lucid, every EV manufacturer on Earth are placing orders right now, today, January 2026, for delivery in Q2 and Q3 2027, and they're looking at the same Oxford Economics forecast. They see 59% by 2031. They see 3.4% annual growth. They know their competitors are ordering too. So what do? They overorder. They secure allocation before someone else does. They lock in supply at today's prices before the crossover hits and prices spike. That's not speculation. That's risk management. That's supply chain 101 in a constrained market. And when procurement managers at a dozen major automakers start over-ordering simultaneously, you don't get gradual price appreciation. You get a run on physical metal, but it doesn't stop at automotive. Solar panel manufacturers are watching the same data. The Silver Institute forecasts industrial silver demand hit a record 680.5 million ounces in 2024, according to the World Silver Survey 2025, with solar representing a major component. 200 million ounces annually if current trajectories hold. But solar manufacturers can't stockpile silver the way car companies can. Silver paste used in photovoltaic cells has a shelf life. It degrades. They buy spot, just in time. Lean inventory, which means when automotive buyers start hoarding allocation in Q1 and Q2 2026, solar manufacturers get squeezed. And when solar manufacturers get squeezed, panel production slows. And when panel production slows, installation projects delay. And when projects delay, governments that mandated net zero targets by 2030 start panicking. And when governments panic, they do what they always do in commodity crises. They secure domestic supply, export restrictions, tariffs on refined silver, incentives for domestic mining with 10-year tax breaks, strategic stockpiling programs. According to Money Metal's November 11, 2025 analysis, there are concerns that designating silver as a critical mineral could lead to import tariffs to protect and incentivize domestic silver production. The very policies that turn commodity shortages into geopolitical trade wars. Now let's talk price targets. 3 scenarios, each based on institutional analysis and historical precedent. Conservative case, $50 to $55 per ounce by Q4 2026. That's a 60% to 75% gain from current levels around $31. It happens if industrial demand grows as forecast with no supply disruptions and investment demand stays moderate. According to goldsilver.com, reporting from December 2025, silver enters 2026 with a rare combination of supply shortages, rising government demand, and supportive monetary conditions. 50 to 55 is the floor. That's not bullish. That's baseline if absolutely nothing goes wrong. If the crossover happens on schedule, if solar demand continues, if AI data centers expand as planned, if no mines have accidents, if no countries restrict exports, if everything goes smoothly. $55 is almost guaranteed. Moderate case, $65 to $75 per ounce by mid-2027. Bank of America's commodity research team, according to carbon credits reporting from December 11, 2025, raised its 12-month silver target to $65 per ounce after real yields narrowed and ETF inflow strengthened. 65 to 75 assumes EVs hit the Oxford Economics crossover point on schedule in 2027. Solar demand accelerates as governments race to meet 2030 deadlines, and investment demand returns to even half of 2020 levels when retail buyers and institutions poured capital into precious metals. That's the scenario where current trends continue without major disruption, but also without panic, where procurement managers secure their allocation, where solar projects continue, where AI data centers get built, where everything happens as forecasted but compressed. That's a 110% to 140% gain. That's not moonshot territory. That's mechanical execution of known trends. Aggressive case, $100 or higher by 2028. BNP Paribas, according to Carbon Credits' December 11, 2025 coverage, suggested silver could climb as high as $100 per ounce by the end of 2026 as investors seek safe haven assets amid persistent inflation and geopolitical risks. $100 requires a catalyst. Catalyst 1, a major mine disruption in Mexico or Peru, which together supply over 40% of global mined silver. A tailings dam failure. A prolonged labor strike like the one that shut down Newmont's Peñasquito in 2024, political instability, environmental regulations that halt production. Any one of those events removes 200 million ounces of annual supply overnight. Catalyst 2. China, or another major refining nation, restricts silver exports to secure domestic EV and solar production. They did it with rare earths in 2010. Neodymium prices went from $40 per kilogram to $450 per kilogram in 8 months. Silver isn't as concentrated as rare earths, but according to FX Street analysis, from December 2025, starting January 1, 2026, China is implementing new export restrictions on refined silver where only large, state-approved companies will be allowed to export, and only after obtaining special government licenses. Catalyst 3. Investment mania. If silver breaks $50 and holds for more than a few weeks, retail FOMO kicks in globally. The Wall Street Silver Reddit community has over 230,000 members. They bought 40 million ounces off the market in 2021 during their squeeze attempt. If they mobilize at $60 with momentum, they could pull another 100 million ounces into vaults. And when you remove 100 million ounces from available supply, industrial buyers panic. They bid whatever it takes. That's when silver goes parabolic. $100 isn't the target in that scenario. It's the first resistance level on the way to 1980 inflation-adjusted highs near $150. Some people argue that high prices will kill demand, that if silver hits $60, automakers will engineer silver out of battery management systems, solar manufacturers will accelerate copper plating adoption, and demand solves itself. And they're partially correct. At $100 per ounce, yes, engineering teams get massive budgets to find substitutes. But here's what they're missing. Redesign takes time. According to industry timelines, you can't substitute silver out of a critical electrical system in 6 months. Battery management systems require 2 years minimum to validate new materials, test thermal performance, pass safety certifications, and retool production lines. And during those 2 years, you still need to build cars, you still need to meet EU quotas, you still need silver. So yes, high prices eventually reduce demand per unit, but not in 2026, not in 2027. Maybe by 2029 you start seeing significant material substitution at production scale, but by then, damage is done. Prices already spiked, supply chains already broke, industrial projects already delayed. And here's the mathematical trap. Even if automotive reduces silver per vehicle from 35 grams to 25 grams through aggressive thrifting, global EV production simultaneously goes from 15 million units to 30 million units. You didn't save silver. You slowed the growth rate. The deficit remains structural. The shortage remains real. Substitution is a fantasy sold by analysts who've never managed a manufacturing supply chain. Here's what happens next. First quarter 2026, automotive and solar procurement managers finish placing their 2027 allocation orders. Silver hovers around $32 to $35 as the market slowly digests the Silver Institute December report and Pentagon designation. Most investors ignore it. Second quarter 2026. First signs of physical tightness appear. Delivery premiums in industrial markets start rising. London and New York inventories, already depleted, show further draws. According to FX Street December 2025 analysis, COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Spot price begins to decouple from futures as physical buyers pay premiums. Third quarter 2026. A catalyst hits. Maybe it's a mine accident in Peru. Maybe China announces phase 2 of export restrictions. Maybe a major automaker issues a public statement about silver supply constraints affecting production targets. Whatever the trigger, price breaks $40 and holds. Technical traders notice. Momentum algorithms trigger. Fourth quarter 2026. FOMO begins. Retail buyers who sat out gold's run to $2,800 see silver at $45 and recognize the leverage. Silver typically moves 2x to 3x gold's percentage gains in bull markets. ETF inflows spike. According to Sprott's mid-year 2025 silver investment outlook, global silver-backed ETPs experienced inflows of 95 million ounces in the first half of 2025. If that pace doubles in late 2026, another 200 million ounces gets locked in vaults. Industrial buyers panic. They forward buy 6 months of inventory. Premiums on coins and bars go to 25% over spot. By December 2026, silver tests $50, holds. And that's the conservative timeline. If any catalyst hits earlier, timeline compresses. If 2 catalysts hit simultaneously, you skip phases. Silver at $65 by summer 2026, $100 by year-end 2026, and at that point, the shortage becomes a geopolitical crisis. Solar projects stall globally. EV production misses national targets. Data center build-outs delay, impacting AI development. Defense contractors compete with consumer electronics for allocation. Governments intervene with emergency measures that typically make situations worse. Meet Yuki Tanaka. She's the procurement director for a mid-sized solar panel manufacturer in Osaka, Japan. According to industry sources, manufacturers like Yuki's facility produce approximately 2 million panels annually, with each panel using roughly 20 grams of silver paste. That's 40 metric tons per year, or about 1.3 million ounces of silver. November 2025, her supplier quoted 6-week delivery at $30.50 per ounce. December 2025, 8-week delivery at $32 or $20. January 2026, her account representative told her they're implementing allocation priority. Multi-year contracts get fulfilled first, annual contracts second, spot buyers wait. Yuki's been buying quarterly to maintain cost flexibility and respond to market conditions. That flexibility just became a fatal vulnerability. She's now competing for allocation against automotive suppliers who have Pentagon-backed purchasing power because electric vehicles are part of national security infrastructure. Against solar developers in Europe who have EU mandate deadlines and government subsidies that make price irrelevant. Against data center builders who have $100 billion budgets and cannot delay AI infrastructure launches. And Yuki is not alone. According to Money Metal's December 15, 2025 analysis reporting on Silver Institute data, about 60% of global silver offtake is for industrial purposes. Industrial demand for silver set a record last year, and it continues to grow. 60%, that's 700 plus million ounces, going to industries that cannot stop production, cannot substitute materials quickly, cannot wait for prices to fall. And when those industries compete for constrained resources, the one willing to pay the most wins. And who's willing to pay the most? Defense contractors building radar systems for the Pentagon, because silver just became a critical mineral for national security. Because military applications don't have budget ceilings when national security is invoked. When the Department of Defense needs silver for missile guidance systems, for satellite communications, for naval electronics, for battlefield sensors, they get allocation priority, and everyone else waits. Yuki's solar panels wait. Hans's automotive connectors wait. Your retail coins and bars you're thinking about buying next month, back of the line, behind defense, behind critical infrastructure, behind strategic stockpiling programs that Congress just funded with billions. And here's where the feedback loop becomes vicious and self-reinforcing. High prices force some industrial buyers to delay projects. Delayed projects mean less silver consumed in Q1 2026. Less consumption should ease the deficit, right? Wrong. Because delayed projects don't disappear. They stack up. A solar farm delayed from 2026 to 2027 doesn't cancel silver demand, it concentrates it. Now, 2027 has the original 2027 demand plus the rolled over 2026 demand. And if 2027 prices are even higher because the EV crossover just happened, some 2027 projects roll to 2028. The pipeline clogs. And when it finally uncorks, because government deadlines become legally enforceable or automakers face crushing fines for missing EV quotas, demand hits all at once. That's not a market correction. That's a stampede. And stampedes break things. Supply chains fracture. Price stability evaporates. Geopolitical relationships strain under trade restrictions. In 2010, China restricted rare earth exports to secure domestic supply for green technology. Neodymium prices went from $40 per kilogram to $450 per kilogram in 8 months. Japan, the United States, and the European Union filed WTO complaints, trade threats, diplomatic incidents, legal battles, over magnets. Now imagine that scenario with silver, a metal used in EVs, solar, AI, defense, medicine, water purification, and 50 other applications where no substitute performs adequately. The geopolitical fallout wouldn't be lawsuits, it would be supply chain warfare. And in supply chain warfare, the metal doesn't get cheaper. It gets hoarded, it gets stockpiled, it disappears into strategic reserves. What this means for you is brutally simple. If you're holding silver today, you're positioned ahead of a freight train of industrial demand that cannot be stopped, cannot be substituted quickly, and cannot be supplied adequately. If you're not holding silver today, you're standing on the tracks, debating whether the train is real while it's accelerating toward you. The Pentagon confirmed the train is real on November 7, 2025, by designating silver a critical mineral. The Silver Institute confirmed the train's velocity on December 9, 2025, 3.4% compound annual growth in automotive alone, 59% EV market share by 2031, crossover point in 2027. Oxford Economics confirmed the train has no brakes, solar demand structural, AI data centers exploding, all three megatrends converging simultaneously, and every single industrial buyer on Earth is reading the same reports you just heard. They're placing orders right now. They're securing allocation today. They're forward buying before the crossover hits. What are you doing? Do not wait for CNBC to run a primetime segment on silver breaking $40. Do not wait for Bloomberg to publish investigative features on critical minerals and national security. Do not wait for your financial advisor to send an email suggesting you consider adding silver to your diversified portfolio. By then, premiums are 30% over spot. By then, delivery delays are 16 weeks from reputable dealers. By then, you're buying retail at $55, while the smart money bought at $31 6 months earlier. By then, industrial allocation locked up available supply. By then, governments announced strategic stockpiling programs. By then, the easy money left the building. The window to position at reasonable prices isn't closing. The window closed when the Pentagon published their critical minerals list. This is the aftershock. This is the last call pricing before markets reprice the reality, 59%. According to the Silver Institute report published December 9, 2025, in partnership with Oxford Economics, electric vehicles will account for 59% of automotive silver demand by 2031. And according to Oxford Economics projections in that same report, EVs will overtake internal combustion engines as the primary source of automotive silver demand by 2027. That's 18 months. Not a long-term forecast, not a distant future projection, a short-term mechanical shift that starts in 2027 and accelerates through 2031. And the United States Department of Defense confirmed the supply vulnerability on November 7, 2025, when they added silver to the 2025 list of critical minerals. They don't do that for abundant commodities. They do it when supply security becomes a national security issue. They do it when they've run the scenarios and realized domestic supply chains cannot meet defense and industrial requirements simultaneously without intervention. Hans in Stuttgart placed his orders. Yuki in Osaka secured what allocation she could. Both understand what's coming. Both are positioned ahead of everyone, still debating whether this is real. You're either positioned or you're not. You're either ahead of the shortage or behind it. You're either accumulating at $31 or chasing at $65. So subscribe now.